Let's see here, the Bloomberg Commodity Index, as of last night, it was up 15.9% year to date. So that's still rising
That's
generally.
that's really the proof of the pudding, because we have all these assets falling, and the commodity inputs of the capital space should also be falling hard, but they're not. They were falling hard in 2008. The fact that they're not falling hard is a very worrying signal. What happens to them when they start printing again?
Wednesday, December 14th, 2022, Maneco 64, home of alternative economics and contrarian views. Today we have a Rafi Farber special. We're going to do an interview instead of the usual video, mainly because I want to talk about the topic of inflation, CPI, and Rafi looks at it pretty much like I do. And we're seeing a lot of people coming out of the woodwork. The people who thought inflation or rising prices would be transitory, they think now that the problem's over, and Rafi is here to counter that alongside me. I thought was good to have another head talking about this. Hi, Rafi, how are you?
I'm good. How are you?
I'm all right, and I saw that you wrote yesterday in your Endgame Investor, and I recommend all the viewers go into Seeking Alpha and look at the Endgame Investor newsletter. It's only about $200 a year, and you get really good analysis almost every day from Rafi. You said that the reason CPI has dropped in the US is because they've been dishoarding the petroleum reserves, and that's made oil look cheaper, of course. To me, it seems like, let's say, someone that is overweight or obese, instead of going on a diet, they go and have liposuction. It doesn't really solve the problem because they'll put it all back on.
Mm-hmm. Yeah, you could look at it that way. I've never really thought about liposuction before, but yeah, I guess I guess you could see it that way.
It just seems to be cosmetic, just to say, "Oh, look, CPI and inflation's coming down," but
Yeah.
on the underlying fundamentals haven't changed. And maybe you could talk a little bit about how confusing it could be, because you've been saying that we're having actually monetary deflation, and very
Yeah.
sharp one, and despite that, prices are still rising.
Yeah. Well, look, before we go into this, you have to kind of realign. If you want to think about this correctly, and there is a correct and an incorrect way to think about it. If you want to think about it correctly, you have to go into the Austrian school, and I would recommend reading Rothbard. His main, I would say, Austrian school Bible would be Man, Economy, and State. And there and in many other places, he says there's no such thing as a consumer price level. It's not really a thing that you can say this is what it is and you can measure it. What you can do is you can look at prices and sort of guess what's going on, but there's no measurable thing called a price level. What there isn't even really a measurable thing called a money supply. I mean, you can get a little bit more exact or a little bit more precise into what money supply is, but you can't even define what we're talking about the currency, but you can't really define what the currency supply is, even, because different people use different kinds of things as a collateral for their currency, and you can't really measure these things either. So once you accept that, then you can look at the CPI and say, oh, it's rising or it's falling, and it's like it's a very loose effect, very very far removed after effect of what is going on at the spigots of the money supply, and even that isn't even exact. So what generally happens here is that the money supply is expanded by the central bank in any which way. It doesn't even matter how. And actually, the one of the first example that I remember that Rothbard uses in Man, Economy, and State is like, let's say the Fed buys my desk chair for like $20 and expands the money supply by $20. So that's inflationary. So yeah, they happen to buy bonds, but like they could buy anything. The reason they buy bonds is because they're in bed with the government, and that helps the government the most, instead of buying somebody's old chair. But either way, it's inflating the money supply. So when the money supply expands, the first things that are affected are the capital prices, because that's at the top of the structure of production. So you have stock market, real estate, and commodity inputs. right? So because that's the beginning of the capital stage. So when the money supply goes up, all these prices go way up, and the last things to be affected are the consumer prices because they were produced a long time ago, right? The structure of production is so long that the stuff you see on the shelves now came from input prices that are maybe 6 months to a year old or however long it takes. I don't even know. So there's a lag. So you're going to see the rising stock prices where the money goes in first. And then maybe a year later or so, the consumer prices are going to be affected by the capital prices that are being affected now. There's a lag. So, but it's the same thing on the way down. On the way down, when they stop printing money, the first things to fall are the capital prices, the stock market, which is in a downtrend since, even before the money supply stopped being printed or expanded. And then you have the falling housing prices. We're seeing that very strongly now. And you have the falling commodity input prices. You're seeing falling. You're seeing some falling commodities, but even now you're not even seeing oil fall that much.
Bond prices as well, I guess.
Yeah, bond prices. Yes, bond prices.
I mean, I've actually checked the Bloomberg. Let's see here, the Bloomberg Commodity Index. As of last night, it was up 15.9% year to date. So that's still rising generally.
That's really the proof of the pudding, because we have all these assets falling, and the commodity inputs of the capital space should also be falling hard, but they're not. They were falling hard in 2008. The fact that they're not falling hard is a very worrying signal. What happens to them when they start printing again? So what you have is when you have the falling assets, the falling bonds, and all these assets on which the bank balance sheets are based, and they're falling fast. So eventually you end up with some kind of a credit crisis in the mechanics of the monetary system. And then the Fed has to print again. It doesn't matter what's happening with the consumer prices. And theoretically, in theory, yeah, the Fed could say, okay, we're going to let it all topple and we're going to let the banks collapse. We're not going to bail anybody out. And we're not going to print any more money. We're just going to keep the money supply at the same level for like 5 years. If they theoretically did that, then yeah, consumer prices would fall, and it would be like the 1930s.
Yeah, they would actually go negative, and people are talking now as if CPI is falling, but no, the rate of growth is falling. It's still rising in the US at 7.1%. Today, the UK CPI just came out at 10.7, and the headlines are, CPI was decelerated from the highest in 41 years, but it's still at 10.7. And also the RPI, which we have, is the retail price index. That used to be what they used to measure prices before 1997. That's at 14%. So despite all the drop in commodity inputs, like you talk, these consumer prices are still rising sharply. And be as it may, we could argue about semantics. The CPI and the RPI and PPI is what people look at as inflation these days. But we know, and that's why I think it's good to know the truth about this. Not the truth, but even Rothbard said, it's not as clear cut. And I think the reason the Keynesians use this stuff is because they're all into equations and they think they can control everything. But like Rothbard and Mises also said, you could have prices of some goods and services going up and down at the same time, and the money supply going up or down. It's all, you can't really control everything.
Yeah, that you can control phenomenally little. You can make logical deductions. That's what you can do.
Yeah.
That's pretty much it.
And I'm not going to mention names, but there's some people, for example, in 2020, 21, they were saying that because money velocity was really low, we wouldn't have what they call inflation or the CPI rising, and they're proven wrong. And now they're saying, this, and by inflation, they mean the CPI. They say it's going to fall out of bed. But I think they're going to be proven wrong. And I just wanted to show you a chart here from, I'm going to share it with the viewers. And because I think this guy, excuse me, Rafi Farber, sorry, not Rafi Farber, Tavi Costa. I get you guys confused sometimes, but he seems to think the same way. As inflation decelerates, investors will think it is the end of it, not my view. And he says this is a structural problem caused by secular forces, wage growth, commodity shortages, reckless fiscal spending, deglobalization. I think the deglobalization has to do with the supply chain, of course. And it
Yeah.
says inflation develops through waves. We just saw the first one, and he shows the inflationary waves in the 1970s. So I think a lot of people think that we're going to go back to the way things have been since like the late 90s, where interest rates are always falling and they're near zero, and they have this neutral rate that they think is around 2%. And what's your view on this inflationary wave? Do you kind of agree with what Tavi is saying here?
Yeah, I do. I'm not that much into the details of how he structures things, talking about wage growth, commodity shortages, reckless fiscal spot. Yeah, that's all true, but I look at things a lot more like broadly, and try instead of trying to section each cause out and assign like a meaning to each one of them.
Yeah.
But like just generally, the structure. He's right about the structure of inflation. It comes in waves because you have a need to print, and then that creates a wave in the capital sector, and then they try to stop the printing because the consumer sector is getting affected, and then that creates a down wave, and then they have to print again, and it's another wave. That's what's going on. And the way Daniel Oliver puts it is that hyperinflation occurs during successive waves of hyperdeflationary scares, and the hyperdeflation or the collapsing prices really scares the central banks, and they say, "Oh, okay, we have to print again," and then you have another wave. But trying to describe the structure of these waves each time they happen, that's also a fool's errand.
Yeah.
And because we don't really know exactly what's causing these waves. I mean, everyone's an individual. I mean, I can give you one example I was thinking of in the CPI, right? So if you, or the RPI, or whatever you want to call it, just like you streamline these things. Like how much I look at one category the most, that's food at home, because that's the most basic of necessities. If you can't afford food at home, you're going to die, or you're going to go to a soup kitchen. So I don't really care about the price of anything else. I care about the price of survival, the price of bare survival. And if you have you can look the CPI, and you can say, oh, prices are rising at 10% for everybody. But let's say you're in a mortgage, and your mortgage payments are skyrocketing because interest rates are going up and up, and you have a floating rate mortgage, and all of a sudden all your purchasing power is going into maintaining your house payments, and you can't afford anything on the CPI, so all you're doing is buying food. And what's the CPI for you? You're losing your savings, you're losing your money. I mean, it's impossible to like take these things and then say this is what's happening to everybody. It's a meaningless statement.
Yeah. And so why do you think I think you mentioned something a few months ago, or you wrote, and I forgot exactly what you said about money velocity, that it's a useless thing. And that's why it didn't work for people who thought we'd never have inflation because the money velocity is so low.
That's totally circular thinking. It doesn't make any sense. It's like an identity or a tautology. The money velocity by definition is GDP over money supply, I think is what it is. Or maybe it's money supply over GDP. It's it's one of those, it's like this huge agglomerative number, meaningless number, which is GDP, which is how much money is being passed around for goods and services in a given time period, over the money supply, which includes all the reserves in the banking system. So like, you're gonna count all the reserves in the banking system that are just sitting there in reverse repos, and then put that back on inflation. I mean, one is the result of another, and you're just going in a tight circle here. Like what is money supply? Money velocity doesn't mean anything. It's just what we see because there's a whole bunch of reserves in the banking system that aren't being spent. But like that could change at any time if, what was it that Zoltan said, that if they run out of oil, then all those reserves are going to have to come out. I don't know exactly how he worked it out, but like we have all this like monetary material and reserves that could come out at any time. We don't know how. And then what happens to money velocity? It just like skyrockets.
And I think also what's important about what people call inflation is the fact that the currency has been debased because the supply of it is going up so much. And even if there's money in the banking reserves, the public is, there's a lot more currency circulating, and also the globalization part, the fact that the supply chains have been disrupted, that affects the prices too. The other thing we could jump into, because you just mentioned Zoltan, and I spoke about what he said in his latest newsletter to his clients at Credit Suisse. And I know Credit Suisse is in trouble, but it doesn't mean to say we can't look at what Zoltan is saying, because I think it has a lot of he makes a lot of valid points. And you talked yesterday about the strategic petroleum reserves, and I see that they're the lowest since 1974. And I think if they keep releasing like about 675,000 barrels like they did last week for the next 365 days, for example, it's going to be almost empty. And it seems to me that I think I told you before we started the interview here that yes, releasing these reserves has brought crude oil prices down, and you think also that Zoltan thinks that Biden and the administration want to be able to buy oil as cheap as possible, because they're going to have to replenish those reserves, and that this gold for oil idea he had will be used. So could you give your view on that?
Well, will Russia accept gold for oil? I hope they do. I don't know if they will, but they haven't shown any indication that they're going to do that. But if you look at Zoltan's argument, it makes sense if Russia really understands that. But well, the argument against it, what I saw is, okay, so the U.S. is pinning Russian oil at 60, so fine. Then he says that, so if Russia accepts $60 is about a gram of gold, let's just say. And so if Russia says, okay, we're going to sell a barrel for a gram of gold instead of $60, they're kind of obeying the price control. But then he says, okay, so what if they offered 2 barrels for a gram of gold? Then what would happen is people would buy gold with the dollars to get oil at half price. And then the arbitrage between gold and oil would even out, and you'd have gold trading at about twice the level. So the argument is, so why wouldn't Russia just sell oil for 1 gram of gold or $60 and then buy gold with the dollars at twice the amount of gold that it could buy, and then it just make money that way? So, okay,
but I think the reason, I don't think Russia wants to have any dollars, because it had hundreds of billions and that was frozen. So
so that's the practical answer. The practical answer is they don't want dollars because they can't spend them for political reasons. But even if they could, let's say they could spend those dollars by offering a discount on oil for gold, they would be increasing, Zoltan says this, they would be increasing the value of their own gold reserves in dollar terms anyway, because they already own a bunch of gold. And the way I look at it philosophically in a monetary philosophy sense, like, what is the money when you're talking about gold versus dollars? Gold is the money, dollars is the substitute. And by offering a discount on oil for gold, then what they're doing is slicing the dollar and destroying its purchasing power for everything. Like, if gold goes to $3,600, doesn't mean that the price of everything doubles exactly. It doesn't work like that. But the prices of everything tend to go higher, very quickly. Exactly how high depends on other things, but I'm not into predicting exactly what.
Yeah. And I think, it's also a little bit political, because I think what Zoltan said as well, why would Russia want to help replenish America's strategic petroleum reserves on the cheap? And I've got here, I don't like to use CNN, the cartoon news network, but this came out yesterday, exclusive: U.S. finalizing plans to send Patriot missiles defense systems to Ukraine. So I think Russia's going to see this as another threat. And this, I think, in my opinion, increases the probability that this might happen. Am I talking about this Zotan thing because I want to see gold go through to the moon or the dollar collapse? Well, I think eventually it will. And if that were to happen, so be it. But it's not the reason why I've been stacking gold and silver. It's because I don't expect, like Rafi said earlier, the central bankers to keep the money supply shrinking for 5 years to bring everything down. I mean, I saw yesterday, I don't know if you saw, I think it was yesterday or the day before, that government spending for November in the US went up like massively, like by 10% from the previous year, and tax receipts went down by 6%. So they're still inflating.
Mm-hmm. Yeah. I mean, I would hope that Russia, I mean, this is the best that we could hope for if the US is going to provoke Putin and Russia like this by sending Patriot missiles. For the best that we could hope for the state of the planet not erupting into nuclear war, which, please God, will never ever happen. And I don't believe it will happen because I do believe that God is watching the planet and he created the planet and he's not going to let that happen. So the best we could hope for is that Russia responds financially. And really, if they do this, if they do what Zoltan says they could do, they could undermine very easily the entire financial system based on the U.S. dollar reserve standard. They could do it just by announcing that. That's all they have to do. Their enemy is very, very weak. And it would be a much easier thing to do than to arm nuclear missiles somewhere, which would be a horrible, horrible and pointless move.
No one would benefit from it. And you hurt your enemy like in his pocketbook, I guess.
Yeah.
So Rafi, just before we finish, usually in the morning I go over where the markets are. So I'm going to share here with you and the viewers where I take that data from IG.com. So just go through here. It's 8:24 a.m. London time. So we got spot gold here, still above 1800. The high's been 13, the low 06. How do you view gold, Rafi? I mean, I'm looking at this chart here, for example, and it looks quite bullish technically. I was looking at this line here. We tested it here. It came back below it. It tested it here, and now seems like it's breaking out. And we've got here the 200-day moving average as well, which we're safely above it now.
Yeah, I think we're above the 200-day moving average. I think we're above the 50-week moving average. It looks like we have another rare triple bottom there at around 16. Oh, this is a long-term chart. Yeah, so we have looks like a triple bottom from 2014. What is it? Is this going back to 1995? Like what is
no, is this back to just 2022, beginning of the year?
Okay. So that's what I thought it was. So
it's the daily chart.
Yeah. So that didn't look right. Okay, so it looks like we have another triple bottom around 1620, 1640. And just from what I saw from when we were around the 1670, 1620 range, if we were going to break 1670, which we did, then it should have broken down, but it didn't.
That's the longer term one here. You know, when we were down here, it wasn't looking very good. But I guess we could maybe call that now a bear trap. You know, people went short. They're thinking, oh, gold is going to 1,000, and then it just reversed and it's now really moving higher. So we're gonna move on here. Silver this morning is actually up slightly. I think yesterday we got above 24, and as people can see here, the Dow, Nasdaq, and S&P futures are pretty much unchanged. And I noticed yesterday, Rafi, after the CPI came out, that the Dow went up 800 points. It was really going crazy, and then everything kind of came off. But gold and silver actually encouragingly stayed pretty firm. I thought that was a good signal.
That looked like a lot of selling on strength to me. It looked like day traders or algorithms traded the CPI, bought, and then a lot of people who wanted to exit positions on that opportunity did it quickly.
Yeah.
That's what it looked like to me.
Yeah. So here are the currencies. We look at the currencies. They look pretty unchanged this morning, except maybe for the dollars down a little against the yen. The dollar yuan is down about a third. It's at 694. And then we look at crude oil. Crude oil is pretty much unchanged. WTI, Brent, copper is up about 1%. And then someone wants us to go over platinum. Platinum is actually up as well. We were trading around 1,005. It's now 1,035. So platinum is picking up a little bit. And yeah, so that's it. Rafi, thank you for coming on this morning.
Thanks for
And,
inviting me.
yeah, you're welcome. And have a great day.
You too.
Take care.